the co-president of Apollo, believes Fed action will limit the damage.
We're sort of a little bit in this interesting Goldilocks period right now. Concern about a slowdown has been on everybody's mind the last 6-7 months. Fed's actually done a really nice job of maintaining higher rates. So I would argue that the Fed put its order back in the market right now.
Right now, the S&P 500 7 points higher. That is up 0.2%. In the lead, consumer discretionary, consumer services, as well as information technology. NASDAQ 100 87 points higher. That's up 0.6%. And the Dow Jones Industrial Average remains lower, down 65 points. 10-year yield is down 8 basis points. That's at 417. The 2-year yield, 4 basis points lower. That is at 458 right now. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. I got a hankering for like a shrimp dish right now for some reason.
After all that lobster
discussion.
shrimp.
That was probably a big one.
Oh, popcorn shrimp.
Popcorn shrimp,
Yes.
sure.
Popcorn
What was I
shrimp.
thinking?
Oh,
Coconut shrimp is another
Yep.
thing. Yeah.
Sure. All right.
Don't sleep on the coconut shrimp.
John Tucker, thank you so much. We appreciate it. Bloomberg Markets today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Red and green on the screen, as John Tucker was just reporting. Yeah.
Point out the Russell 2000.
Let
We
it go.
talked about how much
Yep.
it's outperformed in recent weeks versus its a larger cap peers, but today the Russell 2000 down about 1%.
Yep.
Compared with the other major averages just being down slightly.
So giving back some of those recent gains. Nora Melinda joins us. She covers the markets for Bloomberg News. She joins us here in our Bloomberg studio in Midtown Manhattan. Nora, what are you looking at?
I wanted to take a look at Take-Two Interactive. Those shares are really falling as much as 3.5% this morning after the company's Rockstar Games unit released the first trailer for its highly anticipated Grand Theft Auto 6 video game. It's set to be released in 2025, and while that trailer is seen as positive, and analysts are noting that the 2025 timeline and a lack of an exact release date has been the source of disappointment and uncertainty. Some analysts are saying that this should be still encouraging for investors because they can use this pullback in the stock as a buying opportunity.
Yeah, Take-Two. So looking at Grand Theft Auto 6, so looks like they put out 2025 as the release, but not a specific release date. So people are more eager to know specifically that year when it's going to come.
Right, and I think the last time that they had released the video game was back in 2013. So this has been highly anticipated, but it does seem a little bit far off. So there's lots of anticipation, but it is causing a little bit of a dip in that stock.
Yeah, you look at that stock, though, year to date, still up close to 50%. So even with today's drop, still quite a rally this year for that share.
Definitely.
What's another one you're keeping a look at? I know that GitLab in particular has been making some moves this morning.
Yes, so GitLab, that is an application software company. It's surging and hitting its highest intraday level since September of 2022 after reporting third quarter results that beat expectations and raising its full year forecast. We did have Truist Securities analysts say that, quote, given the momentum, we believe guidance may prove conservative as early tailwinds from multiple growth drivers begin to take hold.
Yeah. CVS is another one, though, that looks like a...
CVS.
V as in Victor.
CVS.
Right. Let's be clear. But CVS is up as much as 4.8% today. It lifted its 2024 guidance and is launching a new reimbursement plan that's designed to simplify drug pricing for more than 9,000 CVS pharmacies. And as we all know, the pharmaceutical industry has received a lot of backlash and criticism for the lack of transparency associated with this drug pricing. So this is seen as a positive, considering the fact that CVS is the biggest drug chain in the U.S.
Yeah. You know, so Nora also covers REITs for us, and in particular, office REITs. So what are you seeing there as far as when it comes to traders trying to place bets on rate cuts and what that means for the REIT space?
Definitely. So I cover both home builders and REITs. Specifically in the REIT space, offices have really been hard hit as of recent. But heading into, in the event that rates do pull back, this could be a positive for the REIT sector. Borrowing costs have really been elevated, and it has really taken a toll on that sector. But, some analysts are saying that there could be some opportunities there. And actually, a recent company actually did initiate some coverage for REITs recently.
Oh, nice.
How about the home builders? I mean, the demand is still there because nobody's selling their existing home. So if I want to buy a house, it's probably going to be a new one.
Yes, that is my favorite story. Home builders have really been on a tear this year, especially since they are taking share from the existing home share market. We do have Toll Brothers, which is a luxury home builder, reporting today. So that'll be an interesting look post-market to see how some of these wealthy home buyers are faring in this market. But we are really seeing home buyers really going toward home builders because there really is no opportunity for those quote-unquote used homes.
And home builders will buy down my mortgage rate if I don't want to pay. Like right now, it's 7.5%. It had been above 8%, and we're going to talk to an expert on this home mortgage thing coming up. But they'll buy down my mortgage so I don't have to pay this 7.5% sticker, right?
Definitely, and it's making it really enticing for buyers. And honestly, there is so much demand that home builders have really been able to provide lots of opportunity for home buyers. But the fact that they're willing to buy down some of your mortgage rates, it makes it a little bit more enticing to go out there and buy. So definitely a sector to watch.
All right, very good. Norma Linda, thanks so much for joining us. She covers all the markets for Bloomberg News, joining us here in studio, as is our next guest, Erica Edelberg. It's a nice segue. Senior mortgage-backed security strategist with Bloomberg Intelligence. All right, I'm looking at my 30-year fixed rate, Erica. It's now, it did peak above, just a little above 8%. Now it's down about 7.5%. Where do you think mortgage rates go? What's your market telling you?
Hi, thanks for having me on. We actually, our kind of base case forecast is for the economy to either, well, Bloomberg Economics thinks it's actually going to see a mild recession pretty early next year, maybe already this year. And that will drive rates lower, and that'll drive Treasury rates lower, but mortgages are very highly correlated with Treasury rates. So we think that by the end of next year, if that forecast comes true, we could see mortgage rates even dipping, perhaps a little bit below 6%, at least heading towards the 6% area. Still high by recent historical standards. I know when we got to these levels recently, everybody thought they were crazy, and then we got above 8%. But yeah, we do see rates possibly falling a little bit, which could pull a few more buyers, even the existing home buyers, off the sidelines.
So for those who ended up getting a higher mortgage rate in the last few years, as obviously the Federal Reserve was raising interest rates, would they be able to potentially refinance for a better rate next year?
Yeah, that does put those buyers possibly in the money, which actually, in terms of our supply forecast, if that rate forecast comes true, we think there will be a little bit of a boost in both, total supply of mortgage-backed securities, which is, of course, my area, and also maybe even, net supply, in that maybe more borrowers, even first-time borrowers, will be able to borrow and take out new mortgages. So we do think that could boost both refinancings, which boost, gross supply, as well as new purchasers, which raises net supply.
So I'm seeing the Bloomberg U.S. Mortgage-Backed Security Index total return actually positive here, up 1.4% this year. You guys are really having a good year. What's been the story in 2023 in the mortgage-backed securities market, and kind of what's your 2024 call here?
Well, it's been a fascinating year, to say the least. It's been a roller coaster of a year.
Okay.
And, we started in an environment very similar to what we have now, where rates were falling, everybody thought Fed tightening was over, soft landing was, all the rage, and mortgage spreads tightened, and everything was up. It was an everything rally, just like we've had in the past month, and everybody was calling for it being the year of the bond. I think it was the best January for mortgages in history, probably. And that got completely derailed by the opposite scenario of an re-accelerating economy, re-accelerating inflation in February. So case study there, which we could still face here, and we have jobs reports coming up, this month, and not our call. But, if we see some surprises where, in fact, inflation is going to re-accelerate, then we could see the opposite. Again, not our base case by any means. Then mortgages probably have a rough year again. And then we had the hard landing scenario priced in March, where all of a sudden, everybody thought the world was ending, banks were going under. Volatility rose, rates fell because people figured that Fed was going to cut at that point if that continued. So then we had total returns great because interest rates were rallying, but volatility rose, mortgages underperformed. So we really, those are the three things we've already seen over the past year. Our call is for a continuation of what's going on at this point, which is a relatively soft landing or at least a mild recession, which could help mortgages do very well next year if that comes to pass.
Where do you see certain barometers like the 10-year Treasury headed next year?
Yeah, so our official call that Ira Jersey puts out is for the 10-year Treasury to finish next year at around the 3.2% range. So down about 100 basis points from where we are now. Again, that depends on the economy slowing and not reaccelerating like it did at the beginning of in February last year.
What happens in your market, the mortgage-backed securities market, when there are few mortgages being written because rates are so high? Relatively few mortgages are being refinanced because rates are so high. What does that do to your market?
Yeah, that's a very interesting question, because what it does to our market is two things. One, it sticks tons of people who took out these low-rate mortgages in 2020-21 when rates were a lot lower, record lows. They get kind of stuck in their mortgages. They don't really want to move. They certainly don't want to refinance. And so those are 30-year fixed mortgages. Now, the duration, the interest rate sensitivity isn't 30 years because they are amortizing, and some people still relocate. But it's still as long. The mortgage index itself has as much interest rate exposure as longer duration, pretty much as it's ever seen in its history. Slightly longer last month when rates were even higher, but nonetheless, what that means is that when rates fall or volatility falls and spreads tighten, it gives mortgages extra sensitivity to that, and it means their prices go up that much more. So that's, in some ways...
So is that your pitch to clients? Like, hey, if you think interest rates are going to fall, don't talk to Ira Jersey. Who cares about treasuries? You want to talk to me because I've got the real leverage.
Yeah, well, you also, versus treasuries, you also have to count on spreads tightening. But since we do think, at least in a mild recession or a soft landing, volatility follows mortgages. They've been very directional with rates. It's been very directional with rates. So if that's your call, yes, mortgages are definitely a better place to be. And in a hard landing scenario where volatility may go up a little bit more, we also think corporates could be in a little bit of trouble too. So then you're also looking, at mortgages being a pretty good idea.
Talk to us about bond funds, households, foreign investors. Will they end up having to absorb most of the supply of agency mortgage-backed securities next year?
Yeah. What's been happening since the Fed started letting its portfolio run down is they had really tightened in spreads in 2021 when they were buying everything in sight to support the housing and the mortgage markets. And they've, of course, reversed that stance. We call it quantitative tightening instead of quantitative easing. And as a result, whatever supply there's been has to be absorbed by other investors. And exacerbating that is the fact that with all the turmoil the banks have been in, they haven't been adding either. And that's created incredibly volatile returns in mortgage-backed securities, because when there is any new supply at all, and it's being kind of supplemented by other investors like banks and Fed not reinvesting, total rate of return investors, risk-reward investors have to be the ones that buy. And if they are in a risk-off scenario, like they think suddenly we're heading for a hard landing or something, or a reacceleration, then spreads widen even more than you might expect, because there's no real less economically motivated buyer like the Fed or the banks to support it. And we think that continues into 2024, because we know the Fed's going to continue running off its portfolio for a while. And we think this is kind of a controversial call, but we think banks are also going to continue to be pretty sidelined, because we think bank deposits are going to continue to stagnate or maybe even go down. And we think that the current losses they have on a mark-to-market basis on some of their portfolios, even if they're not officially marking some of these held-to-maturity assets to market, are going to give them second thoughts about buying more mortgages right now. So, yeah, we think that there's going to continue to be some volatility in terms of returns because of the type of buyer that we're relying on.
How does that affect bigger banks versus, say, the regionals when you were just talking about those types of issues?
I mean, bigger banks tend to have deeper pockets. They tend to have they're more strictly regulated to begin with, so they probably were already a little less at risk than the Silicon Valley banks of the world were. So I think we know at least more where their skeletons are hidden, and that gives them a little bit more latitude to absorb some of those losses.
So is it your sense that MBS could be the best performing fixed income category in 24?
I'm not a super expert in all the other sectors, but I think they have a fighting chance of doing very well in 2024.
So this is, and when you talk to clients, what's their view of the mortgage-backed security market? When you talk to investors.
I think most of them are pretty positive. The problem is, again, that we don't have a natural buyer in some ways, and a lot of the money managers went into this year underweighted mortgages and are now overweighted mortgages. So as much as we're saying that asset managers are going to have to absorb a lot of the slack in the sector, I don't know how much more room they have to add slack to that slack.
Okay, very good. Erica, thank you so much for joining us. Erica Edelberg, mortgage-backed security strategist for Bloomberg Intelligence, maybe a leverage play on falling interest rates in 24, if that is your call. So I don't know. I'm looking to refinance my mortgage, Jess. I got it, at 6%, which I felt I was getting robbed back in March of this year. Then the rates continued going higher to north of 8%. Here we are at 7.5%. So I feel like I'm like a real estate guru here.
325.
325. John Tucker sitting back with his 325, never moving from the Jersey Shore.
He doesn't move, and then millennials like me can't buy homes.
That's
so.
right. See, that's
I can rent
Those
you
are
out
the ones we're talking about. You lock that in, you
The
never
lawnmower
leave,
shed
and then
looks
I'm without
great.
a house.
Exactly.
Living in a rent-stabilized apartment in Manhattan.
You got to hold on to that with two hands there. S&P 500 off 0.1%, the Dow off 0.4%, Nasdaq showing a little bit of green on the screen, up about 0.3%. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Closing arguments are underway in Boston for the antitrust trial of JetBlue and Spirit Airlines' proposed $3.8 billion merger. Now, U.S. regulators want to block the deal as part of a crackdown on industry consolidation. The airlines claim it would allow them to better compete with major airlines and provide better customer service. JetBlue right now down about 2%, Spirit Airlines down about 5%. The rivals of bankrupt trucking company Yellow are scooping up its terminals.
The defunct cargo hauler will sell trucking terminals to more than 20 companies for just under $2 billion. Court papers show Yellow will sell 128 properties it owns, while another 46 remain for sale. The winning bidders include XPO, Estes Express Lines, and Saia. Yellow, which shut down when it filed for bankruptcy earlier this year, owns hard-to-replace properties in many big cities.
And that was Bloomberg's Steve Podest reporting. Shares of Take-Two Interactive are lower after its Rockstar Games unit said Grand Theft Auto 6 won't be released until 2025. Now, Bloomberg's Isabel Lee said it's due to a leak of the game's trailer.
Analysts saw the trailer as a positive, but still, the fact that it was being published in 2025 and the fact that there's no set release date is what's causing some disappointment. Now, why is this closely watched? Because Grand Theft Auto 6 is likely to impact Take-Two's revenue growth. So if you recall, the previous game, which is Grand Theft Auto 5, debuted in 2013, and it was the second best-selling video game in history.
Take-Two down about 2%. And nearly 7 million 23andMe customers had their data compromised by a hack attack earlier this year. It included health-related information based on their genetic profiles. Those are the company stories we're following. I'm Lisa Mateo.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We have data in the driver's seat today. The Labor Department's job openings labor turnover survey dropping to 8.73 million in October. That was lower than expected. It could be more evidence the labor market is fraying, and the Fed's rate hikes on course to slow the rate of inflation. S&P 500 right now 7 points lower. That is down 0.2%, 45.61. The Dow Jones Industrial Average down 151 points right now. That's a decline of 0.4%. Nasdaq 100, that remains higher, up 10 points, up about 0.1%. Now, in the yield space, the 2-year yield 3 basis points lower at 4.60. The 10-year is down 7 basis points at 4.17. Among some of the earnings movers today that include AutoZone, the auto parts retailer, reporting mixed results after the fiscal first quarter, with comp sales missing expectations. Shares right now up 0.3%. And then GitLab, the corporate software company, posting better than expected results for the third quarter, issuing a strong forecast for fiscal year 24. The shares right now 13% higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, you're going to want to stick around for this next segment. Trust me here. Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Fascinating column out today. Must read is the first thing I read as I was stuck on my train. From Matt Winkler, Editor-in-Chief Emeritus for Bloomberg News, talking about a topic we've been talking about a lot, Texas, and kind of limiting the number of banks, for example, that will use in some of their municipal underwritings because of maybe some of the policy positions that some of these banks have.
Sustainable energy, ESG.
Yeah, and my simple take was, isn't that going to cost them money? Like, if I have fewer banks bidding on my bonds, isn't that going to cost me more? I don't know. Matt Winkler, he tackled this issue with the numbers, with the data, as he typically does. Texas socialism foists hidden tax on citizens. Matt, thanks so much for joining us here. We really appreciate it. Put the numbers to this, because this is something we've been talking about over the last few years as it's become more and more of an issue for Texas and some other states, kind of making some investment choices that, I don't know, just don't seem optimal. What did you find?
So since 2021, when Texas essentially prohibited banks that are inclined to favor sustainability as a position in their investment outlook, in their performance outlook, as well as an aversion to lack of safety for firearms, those two things. And Texas went ahead and said any financial institution that is so inclined, we will bar that bank, whoever that bank is, and they happen to be the banks that you've heard of, starting with J.P. Morgan Chase, for example, which is the #1 bank in the world by market value, but it's also the #1 bank in Texas. And we will not allow them to underwrite our securities. Well, that in and of itself, since 21, has clearly been a bigger cost for the taxpayers of Texas. We know that because there was an initial study done by the Wharton School of Business at the University of Pennsylvania, and it found that at least, $500 million is probably going to be the cost. But it gets worse than that because, as you said, when you have the top banks in the country, all of whom, by the way, do favor sustainability, they account for at least 25% of all the new issue of municipal offerings in the country, coast to coast, north to south, east to west, et cetera, in Texas as well. And that reduces the distribution, it reduces the liquidity, and so over time, we do know that Texas already is bearing a cost. How do we know that? Texas is a AAA rated borrower. California is rated AA-, not as good. in California since 2021 is actually borrowing at a lower rate of interest than Texas,
Wow.
which defies, of course, the laws of gravity and all kinds of other things. But there's a reason for it. This is where policy making can get in the way of sound economics, and that's what's happening in Texas. But it even gets worse than that. The biggest investor, if you like, in the world is BlackRock, and BlackRock happens to be the biggest investor in the Texas domiciled companies that are engaged with sustainability. Those companies, by the way, are outperforming the rest of corporate Texas. They're doing better in terms of total return and just about every other measure. And BlackRock, of course, has been singled out repeatedly by Texas as not part of the, if you will, club that is committed to fossil fuel, even though BlackRock actually does, in fact, have myriad holdings in traditional energy, but it happens to be a big investor in sustainability as well. So you get it both ways, equity and debt.
Just a red headline crossing the terminal. I want to report that House Republican McHenry won't seek re-election. That's according to Politico.
So you could argue that this is a hidden tax, but those who are aware of it, how are they feeling? Is it something that they'd want to pay extra for? Is it something that they don't want to pay for?
Well, if you're a Republican and the Republicans control, as you well know, the executive and legislative branches of Texas, and they are responsible for these prohibition laws that were enacted in 2021. If you ask people who are not Republicans, of course, they would completely disagree with it, and many of them do live in Texas, by the way. Texas is actually politically a lot more mixed than you would think, but because of voter suppression and gerrymandering, which have been part of the prescription of the Texas Republican Party, you wouldn't know that just from the makeup of the legislature itself. However, there are plenty of people who are, obviously in favor of dealing with climate change. Who isn't, by the way, at this point?
You know, it's interesting in your piece here, Matt, you mentioned, I didn't know this, New York-based BlackRock manages about $4 billion for the $179 billion Texas Teachers Retirement System of Texas. So they're doing business, or the state is doing business with many of the big institutions that they are publicly, I guess.
And here's what, in a way, goes without saying. I didn't say it, but it should be said. You know, BlackRock, when compared to its peers, at least 80% of all the money it manages has outperformed its peers worldwide. In other words, BlackRock has done a better job earning you a return than all of its competitors for at least 80% of the money it has on management. And that's why BlackRock, in part, is as big as it is. So they're doing their job by earning investors, the best returns, and they're doing it for the Texas retirement system as well. But Texas somehow doesn't think that's acceptable.
Do we have a sense of how much money this could cost taxpayers in the long run if this is something that continues to move forward in these types of policies in Texas?
Well, of course, it's going to be billions of dollars, because if you think about every year that they borrow. And Jamie Dimon, by the way, the chief executive officer of JP Morgan Chase, in fact, reminded Texas, the people in Texas, that we're talking about hospitals, schools, all kinds of municipalities in Texas that need money and, in fact, have historically relied on banks like JP Morgan. If they're not there, those institutions are actually going to pay an increasing amount relative to what they should be paying because of these prohibitions.
Despite all this, it just seems like we read day after day, company after company moving to Texas for a variety of reasons, mostly, I guess, largely in part due to lower taxes. But how do you square that?
Well, you have to be careful about when you say companies moving to Texas. Moving a headquarters, as Elon Musk did with Tesla recently, 2021, is one thing. Moving your workforce is quite another.
Right.
Tesla has 49,000 people still in California happily making the vehicles for Tesla, and SpaceX is there. And actually, Tesla moved its engineering headquarters back to California recently.
Did they? Wow.
Because they want to be where the smartest people are, which is
Right.
kind of the footnote in all of this, isn't it?
It's interesting, though, again, in your piece, you highlight a couple of renewable energy companies, sustainability, Sonova and Quanta Services. You know, it's interesting that they are just originated in Texas.
Yeah, look, Texas has lots of, if you will, resources, including entrepreneurs.
Yeah, sure.
And, you know, they are doing what they should be doing, which is finding ways to be innovative. And these are two good examples of that.
Yep.
What's sad is that the government, such as it is saying, well, actually, we don't think certain kinds of investors, including the ones that outperform every other kind of investor, should be supporting anybody in Texas. And that's where you get the statist line.
Yep.
And it's not free market capitalism. It isn't anything Adam Smith would be endorsing in The Wealth of Nations.
Yeah, interesting. The math, the numbers really put a, you know, kind of really make it come right out at you, some of the costs that are being borne here. But I have to see how this plays out. Matt Winkler, thank you so much for joining us. Matt Winkler is the founder of Bloomberg News. He is the editor-in-chief emeritus, joining us live here in our Bloomberg Interactive Broker Studio. You can find Matt's opinion pieces as well, all Bloomberg Opinion. You can go to bloomberg.com/opinion, or if you're on the terminal, OPIN Go, and that's where you find all the fine work from our Bloomberg Opinion columnists. And some great stuff every day they crank out. S&P 500 unched on the day. Right now, let's head down to Washington, D.C., world and national news with Amy Mars.
All right, thank you, Paul. As Israel expands that fight against Hamas, officials say they would consider another ceasefire with Hamas if it can reach a deal to free more of the 137 hostages still being held in Gaza. Bloomberg's Jody Schneider has more on that from Washington.
Obviously, Israel is this is their goal to end Hamas's existence in Gaza, but also to get those hostages out. Securing the release of all those remains an aim of the war.
Bloomberg's Jody Schneider in the nation's capital. Climate change talks at the COP28 summit in Dubai are getting more complicated. Saudi Arabia says it will not sign on to an agreement to phase down fossil fuels. We got reaction to that from White House Special Climate Envoy John Kerry.
What we are for, the United States has said, and we said it in the G7, and all G7 members voted for this, that we are for the phase out of all unabated fossil fuel. Unabated. Why? Because the science says you have to reduce the emissions.
Former Secretary of State John Kerry says scientists are using the words alarming and terrifying to describe the challenge the world faces. He spoke at the Bloomberg Green Forum on the sidelines of COP28 in Dubai. Arizona's Democratic governor is fed up with border decisions made by the feds. The latest involves the closure of the Lukeville border crossing after Border Patrol agents there said too many migrants were coming through. Arizona Governor Katie Hobbs says this means those legally coming cannot come through, and those illegally coming will make other Arizona towns along the border more vulnerable.
This is a bad decision that impacts our border security. It hurts our economy because it's putting a damper on trade and tourism.
Texas border crossing point was also shut down to shift resources to illegal entries. Global news 24 hours a day and whenever you want it on Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
analysis, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The labor market slowdown reinforcing speculation the Fed's going to be able to cut interest rates next year to prevent a recession. Yields dropping across the curve as job openings hit the lowest since March of 2021. S&P 500 has shaved some of the earlier losses led by the mega cap space, with Tesla, that's up about 3.8%, Apple up at least 2.2%, and the banks in that space, they remain under pressure after KeyCorp's non-interest income outlook. KeyCorp shares, they are lower, down about 3.2% right now. Meantime, Torsten Slok, the chief economist at Apollo Management, has a new twist on the idea of a soft landing in the U.S. economy.
Jobless claims has been surprisingly resilient for a very long period now. It's beginning to look more not like a soft landing or hard landing, but more like a long-term landing. We're waiting more and more and more for any evidence of either a sharper slowdown or an acceleration.
Right now, the S&P 500, let's call it unchanged, 45.69. Dow Jones Industrial Average, 106 points lower. The NASDAQ Composite Index is up 46 points. That's a rise of 0.3%. Two-year yield is down 2 basis points, 461 there. The benchmark, the 10-year, is down 7 basis points, 417. Economic output shrank in 6 U.S. states in the second quarter of this year. This according to data published today by the Bureau of Economic Analysis. The biggest contraction came in the state with the smallest economy. You want to venture a guess? Not the smallest state, the state with the smallest economy.
North Dakota.
No. I'm going there in a few weeks to go skiing.
In North Dakota?
No, I said that's not the
Vermont.
Thank you. Yes, the Green Mountain State, smallest economy.
Is that right? The smallest economy?
Yeah.
Wow. Maple syrup, not that big a thing, I guess.
I would, I don't mean to diss them because I love going there to ski at Killington. But
University of Vermont.
When I used to go as a little kid skiing, it's just I would say it's just not the same place. It's lost a bit of its charm.
Every place has, John. Everywhere has.
Including in here, apparently.
Yes, exactly.
Boost your spirits. Come on now.
All right, whatever.
Great skiing in Vermont. That's where I learned how to ski. And my memories of Vermont are me shivering on the chairlift next to my dad underneath a blanket, like in Killington.
He's like, buck it up, kid.
Exactly.
Did he give you a coat or just a little blanket?
It's like 30 degrees below zero, wind whipping.
Paul used to ski without a coat.
Without a coat.
Walked to school in his bare feet.
Absolutely.
Suck it up, Tom.
Tough times back there. Loved the memories of skiing up in Vermont. Good stuff. John Tucker, thanks so much. We appreciate it. Jess Mint, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. Let's get right to it. It is December, which means we're ready to flip the calendar to 2024, start reading some of these outlooks for 2024, and we're going to do that with our next guest. Jeff Kleintop, he's a chief global strategist at Charles Schwab. Jeff, thanks so much for joining us. MBA from Penn State. You can stay. I like that. Go Nittany Lions. We'll see them in the Sun Bowl coming up here. I don't know what it is. Hey, Jeff, what are we looking at here in 2024? I mean, we had a nice equity rally. Even the fixed income market kind of recovered from 2022 a little bit. What are you thinking about for 2024?
I think when we're defining...
Oh, I think he froze for a second there. We're going to work on that.
All right, the Zoom froze.
Back,
but we want to talk about, because even the Bloomberg Intelligence, those folks have been writing all of their 2024 outlooks, and that's what we've been featuring on our weekend show.
Yeah.
BI, so
and if you look at sort of Jeff's call here in some notes, they were talking about sort of the big picture they're looking at for next year is what they are calling a shallow U-shaped recovery. I know how we like to do all these different shapes when we're talking
U-shaped versus a V-shaped versus maybe a W-shape, up and down.
Yes.
That kind
so
of thing.
They're looking at U-shaped for Jeff as far as what they're looking at the trajectory for the global economic, but also earnings growth. So rather than the V-shape that we were talking about in the last two global recessions, obviously, when we think about the pandemic and then the global financial crisis, but interesting enough, when we think about what's happening, more of the economy, but then also when we're looking at the earnings side of things, Paul, because we do our earnings watch columns on our U.S. equities team. But when you look at overall growth for the third quarter, coming into it, there was a lot of gloom. But it looks like the actually average consensus coming into the third quarter was for a contraction of a little over 1%. But if you look at where things stand now, with the majority of companies reporting in the third quarter, coming in a lot stronger than that, north of somewhere around actually 4% growth for that quarter. So you're seeing a lot of industries, especially on a 12-month basis, if you're looking at industrials, discretionary, technology, even a little bit of energy, the earnings outlook improving over the next year for that.
And here's the thing. I mean, if you look at the S&P 500 and you look at the earnings estimates, the bottoms up, and you can do that with SPX index, and then I go EE function for the earnings consensus overview. 12% earnings growth is a consensus for next year. And so one of the questions when you get strategists on is, how comfortable are you with that number? I mean, people are talking about, or economists are talking about a slowing economy, which we've seen data to confirm that. The economy, while still growing and still healthy, is slowing. Can that support 12% earnings growth next year? So that's kind of one of the questions you have to ask yourself here. And that's been ticking up a little bit just over the past couple of weeks as well.
It has. And usually each Friday, those earnings estimates in the BI Go function, you can go to equities.
I've heard about them.
Yes, and you can make your way to fundamentals. And then that's when you can find all of the Bloomberg intelligence data that looks at the forecast time series, also the earnings estimates. So yeah, you look at 2024 earnings up more than 11% growth, and you look at 2025 also around 12% earnings growth. But then squaring that away with, we were talking earlier about the ECFC function in the terminal, so the consensus estimates for economists in the terminal. So they aren't seeing contraction in growth, but they are seeing, if you are looking at quarter over quarter, things to slow down a little bit in the first and the second quarter. So then you kind of have to square that away with also the earnings outlook and what that means and whether or not, which one is wrong, right?
And Gina Martin Adams, she said from an earnings perspective, the earnings recession was actually last year.
Yes.
In the third and fourth quarter of 2022.
That's correct. So if you take out the energy sector is what she looks at, because that was skewing some of the numbers. So actually the contraction in growth started in the second quarter of last year, and then that actually ended over this summer. And so you could already see, because last year the earnings outlook was improving for energy because of that correlation with higher commodity prices, inflation. And then the flip side was different this year when you started seeing the earnings outlook dim as inflation was obviously improving.
Yeah, and it's interesting when you talk to some bears out there, like, for example, time to time, Doug Cass, who is someone we speak with on surveillance, a famed money manager, and from time to time, just recently, he'll get bearish, outright bearish. And I'm like, how can you be bearish if, in fact, you have earnings growth next year, if, in fact, you have had peak rates, and rates are expected the next move to be downward? That seems like a constructive background, if nothing else, for stocks. And I think maybe that's kind of what we saw in the month of November, that rally.
Yeah, and I mean, can we talk about how wrong Wall Street equity strategists were coming into this year? So they were thinking on aggregate that the S&P 500 would end the year around 4,000. If you look at where the S&P 500 is trading now, 45.67, so well above what those strategists were thinking coming in back last December and January. But then if you look at the Lou Wang, who's one of the star reporters on the cross asset team, she always puts together a table of the average and median as far as the levels that strategists are looking at. So more than 24 strategists on Wall Street right now. If you look at the close for 2024, the average would be 45.46, which is just below where the S&P 500 is trading now. So if you look a year out, they're thinking basically the S&P 500 is going to go nowhere next year?
Yeah, it seems. I mean, it's had a big run here, and I am looking at Lou Wang stuff. I just set an alert for that because I want to get that every time it pops up. But again, yeah, we're here at 45.68, kind of flat on the day, but, up 17, 18, 19% on the year. And even if you back out the Magnificent Seven, which has obviously been the primary driver of performance in the S&P 500, you're still up 5, 6, 7% here on the equal-weighted S&P. So still some performance there. But again, if you think about where rates are likely to go, where they're expected to go, particularly if you look at the warp function, looking like rates will be headed down at some point in 2024. And if those earnings estimates hold up, that in a lot of folks' mind, could be a good backdrop for stocks. Right now, S&P is unchanged on the day. Dow off about 0.3%. The NASDAQ up about 0.3%. And the Russell, we've been calling that out. It's been outperforming over the last couple of weeks. It is down 0.8%. We're going to have more coming up. This is Bloomberg. at some company news right now with Lisa Mateo.
Thanks, Paul. Shares of CVS Health, well, they are higher. Right now, they're up about 4%. And this is after the drugstore chain delivered a sales outlook that beat expectations. Now, the company also announced a new pharmacy reimbursement model. It's called CVS CostVantage. And it says it's going to bring greater transparency and simplicity to the system. It's expected to launch in 2025. Shares of AutoZone, well, they're fluctuating, and this is after it reported results that beat expectations. Bloomberg's Abigail Doolittle has more.
They did beat earnings. Same-store sales also showed growth of 3.4%. So investors basically cheering it, but revenue's flat, so that could be holding them back.
Now, right now, AutoZone is down, actually up just a fraction. And Ericsson beat Nokia to the punch after it landed a $14 billion contract with AT&T to modernize its wireless network over 5 years. Bloomberg's Simone Foxman says it's part of a bigger shift called Open Radio Access Network Technology.
This allows AT&T to really rely on more vendors than just one, than just Ericsson, in parts of its infrastructure. This is a movement that really was catalyzed by the elimination of Huawei infrastructure over time. And so this is what Ericsson calls a strategic shift for AT&T.
Ericsson's ADRs right now, they're up about 5.5%. AT&T is up 2.5%. Nokia's ADRs up down about 3%. And Meta Platforms IBM leading an industry-wide coalition to share artificial intelligence technology. The tech giant joining more than 40 companies worldwide to form the AI Alliance. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, we've got some declines here in the stock market here this morning. The S&P off about 0.25%. The Dow's off about 0.4%. NASDAQ pretty much unchanged here. Yields there coming in, the 10-year Treasury yield in about 7 basis points, 4.18%. So nice move down there. WTI crude oil up about 1%, just under $74 a barrel. On gold, giving a little pause to its recent rise. It's off about 0.7%, $2,013 for gold. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. The battle over free speech and anti-Semitism on college campuses is playing out on Capitol Hill. The presidents of Harvard, MIT, and the University of Pennsylvania are appearing before a House committee at this hour right now, addressing their response to campus protests since the October 7th Hamas attack in Israel. Apollo Global Management CEO Mark Rowan is a Penn alum, and he's called on donors to withhold their support until the university's president and board of trustees resign.
The underlying culture that permitted this to happen is just so strong, and until there is a moment of self-reflection where we're not dealing with just anti-Semitism, we're dealing with the culture that allowed this to happen, there really is going to be no progress, and to date, there's been no progress.
Apollo Global Management's Mark Rowan was a guest on Bloomberg Surveillance. The world is not likely to meet the 1.5 degrees Celsius global warming target from the Paris Climate Agreement. That's what we're hearing from Ray Dalio. The founder of Bridgewater Associates is at the COP28 Climate Summit in Dubai, and he says dealing with a warming planet is going to be expensive.
It's going to be $5 to $10 trillion a year. And so we are living in a world that really doesn't have enough money. So even if we're fiddling around with, like, how is this going to work from the money point of view, you have to look at who has the money and what are their motivations.
Speaking at the Bloomberg Green Forum in Dubai, Ray Dalio says the newly announced Altera Climate Fund from the United Arab Emirates aims to mobilize $250 billion by the end of the decade. Liz Cheney says she's weighing whether to mount her own third-party candidacy for the White House as she vows to do, quote, whatever it takes to prevent former President Donald Trump from returning to office. She tells the Washington Post that several years ago, she wouldn't have even considered a third-party run, but she says, quote, democracy is at risk at home. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
All right, Amy Morris, thank you so much. We appreciate it. Well, it's a tough time on Wall Street right now. Deal flow is down pretty significantly, but Goldman Sachs will probably see compensation costs climb by a percentage in the low single digits, even with the bank set to post another year of slumping profit. The Wall Street giant will continue to pay based on the performance of its businesses in a year in which trading held its ground and other pockets of the firm were hit by a slowdown. Chief Financial Officer Dennis Coleman said at the bank's financials conference Tuesday, adjusted net income expected to decline this year by about 25%. That's according to analysts surveyed by Bloomberg. But you got to be careful. Goldman's top leaders have focused more attention on the bonus pool after saying last year's pay slump contributed to public sniping that was targeted at Chief Executive Officer David Solomon. This year's pay decisions also signaled a more measured move after 2 consecutive years of wild swings in compensation. That is a dicey issue to manage for Wall Street executives.
And Dennis Coleman, the CFO of Goldman, said he expects a more hopeful backdrop for deal making in 2024. But to your point, looking at what Coleman is estimating for fourth quarter trading revenue will be flat relative to a year earlier. And he did say, obviously, those deal making fees have been muted, but he is forecasting potentially brighter times ahead for next year, Paul.
Yeah, but top management has been spearheading a fresh strategy pivot, asking investors to be patient as it unwinds a failed attempt to expand in consumer banking. The firm is offering a more focused vision built around the money management business and the investment bank, which houses the trading and deal-making operations. That, to me, having followed Goldman for more than 30 years, that makes sense to me. That's kind of their core strengths here. Looking at the stock for Goldman Sachs, it's off about 2.4% today, pretty much unchanged on the year. The company's got a market capitalization of $115 billion. So we're looking to kind of right the ship a little bit. Hopefully 24 will be a better year for capital markets activities. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk private credit, exploding market in terms of size. Hugh Van Steenis, Vice Chair and Partner at Oliver Wyman, is going to join us to talk private credit. Then we're going to talk about some stocks we might be good winners in 2024. Tom Ogner, Portfolio Manager at Allspring Global Investments, is going to join us on that. Then we'll take a look at the bond market. Natalie Trevithick, Head of Investment Grade Credit Strategy at Payton & Regal, is going to talk about the bond market, where there might be some opportunities here as we finish out the year and look into 2024. But first, let's start with Charlie Pellet, getting Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. We're looking at a mixed market here. NASDAQ pushing higher, NASDAQ 100 as well. The Dow, the S&P, and the Russell 2000 are all declining. Treasuries resume their rally as further labor market slowdown reinforced speculation that the Federal Reserve will be able to cut rates next year to prevent a recession. Right now, we have got the 10-year yielding 4.17%, the 2-year 4.59%. Spot gold today is down $14 the ounce to 2015, drop there of 0.7%. Bitcoin now at 42,790, up another 1.8%. And West Texas Intermediate crude is up 1.2%, $73.90 now for a barrel of WTI. Equities trading mixed, with the S&P down 5 now, a drop of 0.1%. Dow Industrials down 130, a decline of 0.4%. NASDAQ higher by 0.2%. Shares of CVS are trading higher now, up by 4.1%. CVS Health plans to change how its more than 9,000 pharmacies get paid with a new reimbursement model designed to simplify drug pricing. The biggest American drugstore chain says it is aiming to make the payment system more transparent by using a formula based on a drug's cost, a fixed markup, and a fee that reflects the value of the pharmacy services. Again, CVS shares up now by 4.1%. Again, recapping, bond yields drop. We have got the S&P up, down 4 right now. The S&P lower by 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Jess Metton and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so head over to youtube.com as well. As Charlie's just reporting kind of a mixed market out there. Let's look under the hood, see we've got some stock movements. What do you got, Jess?
Well, the New York Stock Exchange, American Options actually experienced a technical issue earlier this morning. So Elena Popina, our star equities reporter on our U.S. markets team, is going to walk us through what we need to know about this.
Hey guys, so yeah, there was a difficulty with trading American style options on the New York Stock Exchange. It was not a huge deal. The issue was with just one unit. You know, it seems like things are getting resolved right now, but some traders got nervous. You know, the bigger brokerages were able to reroute the trades to other exchanges. Some of the smaller ones, you know, had a bit of a struggle. That makes some people on Wall Street a bit nervous. You know, again, not a huge deal, but it was an interesting development.
Man, so keeping you busy this
morning.
For
sure. Yes, for sure. Absolutely.
What about individual stocks that are moving?
Oh, a lot is going on today. I know Procter & Gamble, I know the household name for all of the Americans, ticker PG, is down about 3%. So the company is saying it will record restructuring and impairment charges. It's restructuring part of its business, and it will record charges of $2 billion and $2.5 billion. You know, investors are not happy about that, so the shares are down. You know, it's not going to be a long-term hit for the company, but that's trading lower, and it's pushing some of its peers lower as well. Then I'm looking at MGM Resorts, a Las Vegas casino and entertainment company, ticker MGM. It's also down 2% after the company's sports partner, Bet MGM, announced that it's viewing next year as an investment year, which means that the negative EBITDA is going to be the case, and shares could, the revenue stream could suffer a little bit as the company focuses puts its money elsewhere. Again, some of the peers of MGM are down as a result of that. If next year is not going to be big for the entertainment industry, then perhaps some of these names, household names, are going to suffer.
I got to think that, the sports betting is such a incredible growth story. And, I think the MGM's their business. I just think it's one of the better brands out there, BetMGM. So I think that's a good long-term investment.
It is, yeah, but if you combine that with a broader concern about where the economy is going to be next year, well, no one knows if we're going to see a recession, and no one knows what 10-year yields are going to be like. So people may, put their money elsewhere and just pare down on betting. If companies are saying that, perhaps they are predicting a slower demand from consumers, just in my theory. But yeah, there are a ton of uncertainties. This year has been a good one for stocks, for the economy, but there are still a ton of questions.
And I was looking at some research from Wells Fargo analyst Daniel Pulitzer as it relates to this betting business. He notes that BetMGM, I guess, has a 2026 EBITDA target of $500 million. That compares to DraftKings' $1.4 billion for 2026 and seniors of more than $500 million for 2025. So maybe he's just saying it looks like BetMGM is lagging the peers a little bit.
It's Tuesday, which means Bank of America's client flows data that we get in our inbox. And I know Elena was looking at it earlier, but it looks like Bank of America clients, they injected more than $2 billion into U.S. stocks last week. And communication services technology stocks looks like those are the ones leading the inflows, Elena.
Yeah, indeed. Some of the defensive sectors saw the outflows. The big tech names, the communication services stars are seeing inflows on the other hand. So it's the repetition of the same old trend we've seen for most of 2023. Whether it's going to continue is a big question. Some people are telling me, look, tech trade is becoming so overcrowded. The communication services trade is becoming very expensive. These valuations are becoming no joke for some of the names. Whether the rally will continue is a question that everyone is asking at this point.
How are hedge funds positioning right now? From your kind of purview, from what you watch when it comes to positioning data in the terminal?
Hedge funds had to increase their stakes in technology stocks and in single name tech exposure, ran from 12% in January to the 99th% by late September, because hedge funds are supposed to ride the wave of the tech rally. They did not position properly in January. They had to scramble to catch up. Right. So they did that in February, March, April, May, June, July, and August. So now they are taking advantage of that. But that's fast money, guys. They are judged strictly. Right. And the 2 and 20 fees are no joke.
Yeah.
I would think a lot of fund managers, if they missed kind of the early first half of the year rally, they got to scramble. Maybe that's what we saw a little bit in the month of November, that big more than 8% move in the S&P.
Right.
Maybe that was in fact some of this fast money, if you will, saying I got to get in this market.
Yeah, it doesn't matter if you like it or not. It's working great. You have to boost your portfolio before books close for the year, and that's what you buy.
You want to keep your job.
Exactly. And I'm also seeing Procter & Gamble stock down about, about 2.7%. They're taking a big charge here. They're going to take a record restructuring and impairment charge, $2.5 billion. So that gets your attention too. They're speaking at a Morgan Stanley Global Consumer and Retail Conference. So if you're going to go talk publicly, you better get all the information out there in a public way. Elena, thanks so much for joining us. Elena Popina, she covers the equity markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Let's talk about private credit. Certainly a big issue for us here. We like talking about it because the growth in private equity is just so extraordinary. I guess we're all comfortable.
Private credit is around $1.5 trillion quarter of the market. So
yeah, and it really took off.
Shabby.
It really took off after the great financial crisis when the banks started pulling back here. So let's talk to somebody who plays in this part of the sandbox. Hugh Van Steenis, Vice Chair and partner at Oliver Wyman. He joins us. Hugh, can you give us kind of your view of where we are on the private credit boom out there? Is it overdone? Is it a healthy market? How do you think about the evolution and the growth of private credit?
Well, Paul, thanks for having me on. Now, look, I think there's a big runway still to come in terms of private credit. And I think it's driven by a couple of things. I mean, first, as you just said, Paul, when you laid it out, the banks have been obviously on a bit of a diet over the last decade, and that's really advantaged some of the private credit players. But I think there's another diet to come. If you look at the Fed proposals, the Fed may be asking the banks to take as much as a 35% increase in capital for their investment banking businesses. Now, I'm sure it's going to get watered down, but that's an enormous squeeze, which means the banks need shared assets. And then secondly, you obviously had Mark Groen from Apollo on earlier today. I think also the regional banks in the States have really got some issues and are selling assets at quite good prices too. So there's an opportunity set of banks shedding assets. And on the other hand, clients just desperate for yield. The biggest source of inflows this year is into private credit. As Jess was just saying, it's grown wildly, but it might double again in the next 2 to 3 years. So for the moment, I actually think the conditions remain very ripe and a really good year for opportunities.
Do you see any sort of red flags brewing within the private credit market at this point?
No, it's a great question. So look, as a long-time banks analyst, any market which grows too fast always creates at least an amber flag, if not red. And look, there's a bit of frothiness, particularly if you look around leverage lending. Prices are becoming tighter. That area is really heavily bid. For the note we put out last week, I worked through that 28 traditional asset managers have either bought another private credit firm or set one up themselves. So there's clearly a bit of frothiness around the leverage lending area. But if I look at the kind of off-the-run deals, whether it's buying bank assets, whether it's more esoteric lending, it still looks quite an attractive spread. So I think the leverage lending is probably the area to look at. And then the second one, of course, is who's the right buyers? Are the buyers ones who understand this is a long-term asset? Because you're basically getting assets which used to be run by a bank, but are now going to get run by a fund manager. Do they have the right skills to work out? Do they understand this asset's going to be illiquid? And as ever in life, we hope that the right buyers buy the right assets, but that doesn't always happen. So that's another area that I'm very watchful for.
Hugh, why do you think the banks are allowing this to happen? I mean, when I was at the Chase Manhattan Bank, we made a lot of money in our leverage lending business. I'm not going to let that business go to the private market. What's happening on the other side of the street?
Yeah, do you know, it's a great question, and it is extraordinary that you're getting even some of the US's largest banks setting up new private credit units. It's really a consequence of regulation. The Fed, or in Europe, the ECB, are trying to jack up the capital charges to hold leverage loans on the balance sheet. But it's not also even just holding them, it's also the trading of them. Now, as you know, and you've spoken about in the last few months, there's an intense battle, a discussion going on between the banks and the Fed about what is the right level of capital for the risks they're running. And the large banks clearly think that they've got sufficient capital. But if the Fed were to apply the rules as they're currently proposed, as I said, it's a 35% increase. That's so ginormous. The banks will clearly need to trim their sheets, shed some assets, be more thoughtful about the marginal loan they make. So I think you're right, Paul. It's been a great business. It should be a great business, but it depends. It's kind of in the gift now of what the Fed will do.
Talk to us about the market for private corporate loans, because right now they're facing, obviously, a very high rate environment for the first time since they really boomed in popularity. What do you think this means next year? Because even if the Federal Reserve holds off on raising interest rates, rates are still very elevated. How does that impact that particular quarter of the market?
No, look, I think that is a really good question because, because the debt is mostly floating rate notes, so in other words, it's being passed on to the corporate directly. Look, as financing costs normalize, some of the weaker balance sheets are going to be exposed. And you've started to see that even in public markets in the last 3 or 4 months. The trade between the stronger sheets and weaker sheets, even in the S&P, has been quite pronounced, I'd say, since June. But you're starting to see that move through the private credit market. Is it possible? Sorry, it would be surprising if there won't be some challenges for some of the borrowers. And I think that's also, why the larger players will need to know, can they work out the asset? Can they rearrange the debts? Do they want to, how do they bail in equity if they need to? And I think that restructuring element is going to become, probably into the second half of next year and beyond, start to become more notable. But, the current credit dynamics that we're seeing in these portfolios, and admittedly, the data could be better, but from what we can see at the moment, they're still performing quite well.
Hugh, I mean, I guess my experience is looking at this marketplace that it's been very successful, but it's been focused primarily on the middle market lending. Do you expect to see these private credit funds write bigger and bigger checks going forward?
Yeah, so definitely we're seeing larger checks. So look, you've seen a $4.8 deal, you've seen a $4.9 billion deal this year. I mean, which would be unthinkable even 5 years ago, let alone beyond that. So you're definitely seeing. Look, in what I think one of the most interesting features of finance is how the winner takes most dynamic that you see in tech and other parts is coming into finance too. You've seen it in the big banks. You've seen it in also some of the big asset managers. And that kind of winner takes most dynamic is coming to private credit too. So look, the top 10 private credit players represent about 40% of the fundraising in the last 24 months. And if anything, it looks like it's going higher. Now, that means they can take on bigger loans, as you said, Paul. But also it means that if you've got a mid-cap bank who maybe has got some of the lending facilities from the Fed that they introduced around the regional bank turmoil earlier this year, if they need to shed a few assets to deleverage their balance sheet, they're going to go to one of these top 10, top 15 firms. So it's not just mid-market lending; it's the larger firms are doing much more. Taking opportunities of quirky off-the-run portfolios from banks, and as you saw that with Credit Suisse earlier in the year or last year, I think this is actually a really interesting theme for some of the more skillful players.
Private debt was supposed to struggle when borrowing costs were rising, but that didn't happen. What was the catalyst to make it as successful as it has become in recent years?
Gosh, that's a good question, Jess, because I suppose in a way we've only look, this is the sharpest rate cycle for since 79-81, but it's only really in the last 12 months it's really kicked in. So to be humble, Jess, we haven't yet seen the full seasoned impact,
the lagged effects
of rates. Yeah, we haven't got as Tom will keep telling me, it's the long and variables, isn't it, which
right.
trip you up. And I don't think we've got there yet. So to be honest, Jess, I don't think you see the evidence. So that's where, look, if you want to be bearish, you can say the season cost coming through will start to be more problematic for some of the mid-market firms, particularly if they don't have other sources of debt available. And in particular, let's be clear, some of the regional banks in the States, you can see in the latest Fed lending surveys and loans, lending rates are slowing quite materially. And so it's not like the banks are going to pick up the slack. So they're going to be more dependent upon private credit. Look, I think like with all of the economy, we've seen corporates and households come into this with a much stronger balance sheet.
Right.
And that's probably why it's taken a bit longer. Sorry.
All right, Hugh, thank you so much for joining us. Great stuff. Appreciate getting a few minutes of your time. Hugh Van Steenis, Vice Chair and Partner at Oliver Wyman, a very long and distinguished career on Wall Street following the financials. So we appreciate getting a few minutes of Hugh's time. S&P 500, pretty much unchanged, off about 0.1%. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Tesla's labor woes are spreading to Denmark. The country's largest union said it will halt shipments to Sweden in support of striking workers there. Bloomberg's Ed Ludlow explains why it's a big deal.
Sweden is Tesla's 5th biggest market in Europe. Not 5th biggest overall, but 5th biggest in Europe. And as you know, Tesla has been holding out on signing a collective bargaining agreement with the unions in Sweden. Collective bargaining a standard practice in that market. Elon Musk has called the Swedish union's approach insane. And as you know, Tesla has pushed back against union efforts in various markets.
Tesla up about 3%. General Motors has pledged to electrify its entire fleet by 2035. But CEO Mary Barra says it's all contingent on one major factor: consumer acceptance. Bloomberg's Joan Doniger has that story.
Barra says GM will be flexible and could back off if consumers aren't ready to make the switch. Slowing sales growth has car makers backing away from their fully charged EV investments. But sales of fully electric vehicles have crossed a milestone marker, 1 million sold in a single year. And that comes just 2 months after the U.S. saw 1 million electric vehicle sales. That includes plug-in hybrids as well as battery EVs.
General Motors is up a fraction. Meanwhile, GM's Cruise robotaxi unit could face $1.5 million in fines for failing to disclose details of an October accident involving a pedestrian. Now, that's according to the California Public Utilities Commission. GM's Barra said it's reviewed view of cruises safety will last into the first quarter of next year. I'm Lisa Mateo. We'll have more Bloomberg Markets in just a bit. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Treasuries resume their rally as further labor market slowdowns reinforce speculation that the Fed will be able to cut rates next year to prevent a recession. S&P 500 index down 5, now down 0.1%. The Dow Jones Industrial Average is also trading lower, down now by just about 145 points. We have down 114 points, I should say, lower by 0.3%. NASDAQ is up 27, a gain there of 0.2%. 10-year yield 4.16%, with a 2-year that's yielding 4.58%. Gold down $9 the ounce to 2019 drop there of 0.5%, while West Texas Intermediate crude is down 0.4%, 72.78 a barrel. Bitcoin continues to push higher again today, building on yesterday's gains. Job openings slumped in October to the lowest level since March of 2021, adding to evidence that the labor market is cooling. The service sector expanded at a faster pace in November as business activity and employment picked up. Reaction to this morning's data from Jennifer Lee, senior economist at BMO Nesbitt Burns, who was a guest right here on Bloomberg Markets.
This morning's two reports, the ISM was up and the jobs were down, job openings were down. So but it's not down enough. We still have over 1.4 jobs available for every unemployed American out there. So that's still a pretty decent job market overall. We're not seeing, 2 jobs for every one person like we did, last year, but it's still a tight labor market and it's still fairly healthy.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Eli Lilly's new weight loss drug, Zepbound, is now available at U.S. pharmacies, offering an alternative to rival medications like Novo Nordisk's Wegovy as supply issues persist. Again, recapping, stocks are trading mixed. S&P down 5, down 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, very good. Thank you very much. We appreciate it. Jess Metton and Paul Sweeney were live here in our Bloomberg Interactive Brokers studio, streaming live as well on YouTube. So you can head over to youtube.com and search Bloomberg Radio. Adding to my argument, my widely held argument here by me, that pound for pound, some of the best money managers are in Milwaukee, Wisconsin, is our next guest.
I
Tom
believe
Ogner.
that.
It is. I don't know what they're doing out there.
It's a hot
Tom
spot
Ogner,
at
Senior
this
Portfolio Manager, Managing Director at Allspring Global Investments. It'll always be strong funds for me with Tom. Tom, thanks so much for joining us here, my friend. Talk to us about this market. We had a ripping November, market up over 8%, yields coming down dramatically. Was that it? I mean, where do we go from here?
Yeah, hey, Paul, great to talk to you again. And yeah, those were the good old days. Boy, it sure seems like we're playing into even the data this morning, the Goldilocks scenario. And I think one of the things I try and do, which I think you always did, which is look over the credit markets and see what they're telling us. And after touching 5%, the 10-year has been ripping downward. And I think even more importantly for us equity investors, credit spreads are hitting new lows for the year. And I think I was looking at it this morning. I think we're all the way back to pre-COVID levels on credit spreads, which means investor risk appetite is up, which is a good thing for equities and a good thing if you're a growth investor.
So what are you advising clients to buy and sell?
Yeah, so we've been telling them, don't miss out. I know it's been a magnificent 7-year, and we've participated with that. We own a lot of those stocks, but we've had smaller mid-cap stocks in the portfolio in trying to find opportunities there. We feel like that probably is the biggest misnomer from a valuation standpoint in the market today. They don't do as well when rates are going up, but if rates continue to go down, as we've seen over the last week or two, you can see small mid-cap stocks really participate in this rally, and I think that's an opportunity. And then the other thing we've been telling them is, yes, technology is important. We like technology stocks, but have diversification in your portfolio.
So outside of tech, Tom, what do you think are some areas? I guess some folks now, after this year and the performance of the Magnificent Seven, they're saying, boy, do I ride these things? Do I try to chase them, or do I just say, all right, I missed that trade. Now let me go find some other good names that maybe have not participated in 2023.
Yeah, we would be barbelling it. So again, I wouldn't be out of those names. I think a lot of them, actually, like an NVIDIA is trading at the lowest PE valuation it has in 5 years. People are doubting the sustainability of the earnings they've been generating. Even if you look over at Amazon, trading about 14 times enterprise value to EBITDA, relative to some of the big media companies, relative to Apple, which trades at, well north of 20 times EBITDA. We think, there's still opportunities there. And then, but I think, go down the market cap, look at places like healthcare, look at some of the things that kind of got destroyed during this GLP-1 phenomenon, which we agree with. Like, there's no doubt that is going to impact healthcare, but it's not going to really destroy the models of other companies. And we think there are opportunities in small and mid-cap healthcare, in particular in med tech. And one of the things that I think is really interesting is you listen to some of these conference calls of companies like a J&J, they are talking about ramping up the M&A playbook again, and that can be very good if you in the small mid-cap space.
You also sent us a list of stocks, one of them Amazon on here, and we're talking about mega cap stocks here. What is it about Amazon that you like?
Well, part of it is they've gotten the religion, right? So they brought in, and I don't think it was a huge surprise to us, but you want to see the execution. They brought in, the CEO came over from the AWS side. AWS historically has run 25-30% EBITDA margins, pretty healthy margins for that business. We don't think the retail side gets anywhere near there, but getting it up from negative to zero to pushing mid-single digits now, we think that is a good opportunity. We think the data center AWS business is bottom out of growth at 12-13%. We know AI takes up a lot of data center space, and we think Amazon, is a good play on that. And that's, again, one that we think is a reasonable valuation, even with the pretty good move it's had this year.
Yeah, up more than 70% year to date, Paul. AMZN, the ticker on that.
Yep, absolutely. Yeah, absolutely. Hey, how do you view AI in general? It just seems like it became a thing so quickly, and investors were just kind of clamoring and forgot, how do they get some exposure here aside from NVIDIA? How do you view AI, and do you have any exposure there that you think is interesting?
Yeah, I think we're believers, and so actually spent all last week talking to companies about it. I think it's like 80% chance this is revolutionary. 20% chance this is kind of a normal net secular shift within the technology space that isn't as big a deal, but we're pretty big believers. We think the dollars are flowing there. If you look at who's spending the dollars, these are companies who've historically been smart spenders, the Googles, the Amazons, the Metas of the world. And we think it benefits not just the NVIDIAs, and we do think it benefits NVIDIAs, but it's going to start spilling over to other companies, other semiconductor companies. We think as you go into next generations, in AMD potentially benefits as you move more into inference from training. We think power management is extremely important, and companies like a monolithic power play into that. And then we think database is extremely important in data management. And there's going to be a few different ways to play that. Our biggest position there in the portfolio has been MongoDB. It's had a great run this year. Its valuation has come up, and lo and behold, they actually report tonight. So I would encourage people to wait and digest that news. But we think the growth tailwinds behind that business are being underestimated and undervalued in the market. So we think it's a good opportunity, but I would digest the new data we're going to get tonight.
What are some stocks or industries that you don't want to own?
It's a good question. I think we're still back and forth on consumer, right? I think the most recent data points have been a little better. If you look at the projections for holiday spending, they look pretty good this year, 5 to 12%, which would be pretty healthy. I think we were at 3 to 4% last year. I think it's, so anything above that would be healthy. I think consumers are moving back to internet online spending, which should benefit those types of companies again. And, I think as was mentioned prior to my segment here that, even though the JOLTS data is showing a bit of a slowing in the job market, there's still 1.4 job openings per job loss out there or job seekers. And so it's still a pretty healthy environment if you're a consumer out there. And so it's not the greatest, but it's not too bad. And so I think there's a lot of back and forth there. And so I'd say we're a little more agnostic in that segment. I'd say you definitely need to be a little picky on what you're investing there. And then I'd say the other area that a little cautious on is what's going on in the industrial segment. We're just hearing of increased tightening there, of companies pulling back a bit. Europe seems like, I don't think it's going in recession, but that growth that had picked up a little bit at the beginning of this year, when we talk to companies, sounds like it's kind of gone the other way again, and that's pushing kind of 0% growth. And then China, to be fair, has been disappointing all year.
Yep, absolutely. Hey, Tom, thanks so much for taking the time. Really appreciate chatting with you. Tom Ogner, he's a senior portfolio manager. He's a managing director over at Allspring Global Advisors.